In 1982, the President of the United States signed a law intended to rescue the American savings and loan industry. Standing at the signing table, he called it the most important legislation for financial institutions in 50 years. He was right about that. Within 8 years, more than 1,000 of those institutions had failed, and the cleanup cost American taxpayers something on the order of $124 billion. The law did not fail. It worked exactly as written. That is the problem. Because what it did, deliberately, as policy, was hand a wrecked industry the freedom to gamble, while leaving the government's guarantee on the losses in place. Free the upside, guarantee the downside, and then act surprised at what people did with it. This is the largest financial failure in American history before 2008, and almost nobody can tell you how it happened. Start with what a savings and loan actually was, because the institution has nearly vanished, and its business model is the whole story. An S&L, a thrift, took deposits from local people and lent them out as 30-year fixed-rate mortgages. That was essentially all it did. It was chartered for that purpose, restricted to that purpose, and for 40 years it was the backbone of American home ownership. The industry had a joke about itself, the 363 rule. Pay 3% on deposits, charge 6% on mortgages, and be on the golf course by 3 o'clock. That is funny because it was true, and it describes a business that required no particular skill. The margin was legislated. Regulation Q capped what banks and thrifts could pay depositors, so no one could compete by offering more. The spread was safe as long as one condition held, that short-term rates stayed below long-term rates. Every thrift in America was making the same bet, without anyone describing it as a bet. Borrow short, lend long, and collect the difference. Then the 1970s happened. Inflation went from under 2% in the early 60s to double digits by 1979. The Federal Reserve under Paul Volcker responded by pushing interest rates to levels no one had seen. The federal funds rate touched 20% in 1981. Consider what that did to a thrift's balance sheet. On the asset side, it held 30-year mortgages written years earlier at 6%. Those cannot be repriced. The borrower has a contract. On the liability side, it owed depositors, and depositors could now earn double-digit returns in the new money market funds, which were not subject to Regulation Q. So money simply walked out of the door. The industry called it disintermediation, which is a mild word for customers leaving because you are legally forbidden to pay them a competitive rate. To keep deposits, thrifts eventually had to pay 10, 12, 14% on assets earning 6%. That is not a bad quarter. That is a negative margin on the entire balance sheet, structurally, with no way to fix it, because the assets are locked for decades. By the early 1980s, the industry was insolvent, not struggling, insolvent. If you marked the mortgage portfolios to market, the collective net worth of American savings and loans was somewhere around negative $100 billion, which brought the government to a choice, and the choice is the hinge of this whole story. Option 1 was to recognize reality, close the insolvent institutions, pay off the insured depositors, and absorb the cost immediately. The estimated bill in 1982 was something in the region of $25 billion. That was politically impossible. $25 billion was real money. It would have to be appropriated, and it would mean a sitting Congress admitting that a beloved industry, the people who financed American homes, was bankrupt on their watch. Option 2 was to let them trade out of it. Give the thrifts new powers, let them earn their way back to solvency, and hope the problem grew smaller rather than larger. The government chose option 2, not out of stupidity and not really out of corruption, though corruption followed. It chose it because the immediate cost of option 1 was visible, and the eventual cost of option 2 was not. That is the same mechanism that killed equitable life on the other side of the Atlantic, arriving from the opposite direction. A cost that does not have to be recognized today gets treated as a cost that does not exist. So what did the new powers actually consist of? 2 laws, and the second one matters most. The Depository Institutions Deregulation and Monetary Control Act of 1980 began phasing out Regulation Q, so thrifts could finally pay competitive rates on deposits. That part was necessary and sensible. The rate cap had become a trap. The same act also raised federal deposit insurance from $40,000 per account to $100,000. Hold that number. It is the most consequential single change in this story, and at the time it attracted almost no attention. It was reportedly agreed late in a conference committee, without extensive analysis, at the industry's request. Then came Garnson-German in 1982, which is the law being signed in the opening of this story. It allowed thrifts to move far beyond home mortgages, into commercial real estate, into consumer and commercial lending, into direct equity investment in development projects. Some states went further still. Texas and California in particular let state-chartered thrifts invest in essentially anything. An institution chartered to write suburban mortgages could now be a property developer, a venture capitalist, or the owner of a casino. Now put the two halves together, because separately they are defensible and together they are radioactive. A thrift that is already insolvent has, in economic terms, nothing left to lose. Its own capital is gone. Any gamble it takes is played with other people's money. The depositors, meanwhile, have no reason to care what it does, because their deposits are federally insured up to $100,000. They are not lending to the institution. They are lending to the United States government and shopping purely on rate. So the discipline that normally restrains a lender, depositors withdrawing money from an institution that looks reckless, was switched off by statute. The result is a machine with a very simple logic. If the gamble pays, the owners keep the profit. If it fails, the insurance fund pays the depositors. Heads I win, tails the taxpayer loses. Economists call this moral hazard. It is normally a subtle effect at the margin. Here it was the operating principle of an entire industry, made explicit by law. And there was an accelerant nobody had planned for: brokered deposits. Deposit brokers would gather money from investors across the country and place it wherever rates were highest, in $100,000 blocks precisely sized to the insurance limit. A thrift in a small town could raise hundreds of millions of dollars in weeks, simply by advertising the best rate in the country. There was no risk premium. Why would a depositor demand one? The government was standing behind every dollar. So the institutions in the worst condition, the ones that most needed to attract money and had the least to lose by paying up, could grow fastest. The market for deposits was rewarding exactly the wrong behavior, and it was doing so because the insurance had removed the only signal that would have stopped it. Some thrifts grew tenfold in 3 or 4 years. That growth was not evidence of success. It was the shape of the disease. Then look at what the money bought. Raw land in the Texas desert, purchased at prices that assumed development which never came. Half-built condominium complexes in Florida. Office parks in cities that already had too much office space. Junk bonds in enormous quantities. In several documented cases, outright fraud loans to friends, inflated appraisals, and property flipped repeatedly between related parties to manufacture paper gains that supported still more borrowing. The Texas boom is the clearest example. Thrift lending poured into commercial property just as oil prices collapsed. which meant the regional economy underpinning every one of those valuations disappeared at the moment the buildings were completed. By the late 1980s, parts of Texas had office vacancy rates above 30%, and the buildings were collateral for loans made by institutions that had no capital. Now the accounting, because this is how it stayed hidden. The regulator permitted what were called regulatory accounting principles, a set of conventions that diverged deliberately from standard accounting. Under RAP, a thrift could count supervisory goodwill as capital. When a healthy thrift absorbed a failing one, the difference between the failed institution's liabilities and its assets could be booked as an asset and amortized over as long as 40 years. Read that carefully. A hole was recorded as an asset. Acquiring a bankrupt institution made your balance sheet look stronger. Losses on sales of assets could be deferred and spread over the remaining life of the asset sold. Appraisals could be optimistic without consequence. The capital requirement itself was lowered from 5% to 3%. None of this was hidden. It was published policy. It simply meant that the number describing an institution's solvency had become detached from whether the institution was solvent. And then there was forbearance, which is the deliberate decision not to close an institution you know is broken. The regulator had a straightforward reason. The insurance fund did not have the money to pay off the depositors of every insolvent thrift. Closing them would have exhausted the fund and required an appropriation from Congress that Congress did not want to make. So institutions that were known to be insolvent were allowed to keep operating and to keep gambling for years. The industry called them zombies. Every month a zombie stayed open. It raised more insured deposits and made more desperate loans. Because for a firm with nothing left, the only rational strategy is to bet big. The estimated cost of resolving the crisis roughly quadrupled during the years of forbearance. Waiting did not make the problem smaller. Waiting was the single most expensive decision made. There is also the supervisory arithmetic, which is almost comic. The industry's assets grew enormously through the 1980s, while the number of federal examiners barely moved. Examiners were paid substantially less than the private sector and had, in many cases, no experience of commercial real estate lending, because thrifts had never done commercial real estate lending before. The people supervising a newly deregulated industry were trained to inspect mortgage files. Which brings us to the part everyone half remembers, the fraud. Charles Keating's Lincoln Savings and Loan is the emblematic case. He bought a California thrift in 1984, moved it aggressively into land development and junk bonds, and used it as a source of funds for his parent company. When regulators moved to restrict it, 5 United States senators, who had collectively received substantial campaign contributions from him, met with those regulators on his behalf. Lincoln failed in 1989 at a cost of over $3 billion. Around 23,000 people, many of them elderly, had bought bonds in Keating's parent company from tellers in the thrift's branches, in the reasonable belief that anything sold at a savings and loan counter was insured. It was not. They lost roughly $250 million. Keating went to prison. So did hundreds of others. There were more than 1,000 felony convictions arising from the crisis. But it is worth being precise here, because the fraud narrative is both true and misleading. Fraud was real, widespread, and criminal. It was also, on most estimates, a minority of the total loss. The larger share came from institutions that were structurally insolvent before anyone stole anything, run by people who were not criminals, making increasingly desperate bets because the alternative was to admit they were finished. Fraud is what the machine attracted. It is not what the machine was. If you build a structure where the downside belongs to the government and the upside belongs to whoever is holding the charter. You will draw in people who intend to exploit it. But you will also destroy a great many honest institutions, and the honest failures cost more in aggregate. The reckoning came in 1989. FIRREA, the Financial Institutions Reform, Recovery and Enforcement Act, abolished the Federal Home Loan Bank Board and the insolvent FSLIC Insurance Fund. It created the Resolution Trust Corporation, whose job was to take over failed thrifts and dispose of their assets. The RTC eventually resolved 747 institutions, holding around $400 billion in assets. It became, briefly, one of the largest owners of real estate in the world, selling desert land and empty office towers into markets that had no buyers. The final accounting from the FDIC's own review put the total cost of resolving the crisis at roughly $160 billion, of which around $124 billion fell on taxpayers, and the remainder on the industry itself. The estimate for closing the same institutions in 1982 had been about $25 billion. That is the price of the decision to wait, roughly 5 times, paid by people who had no part in any of it. So what is the mechanism, stated cleanly? An institution whose losses are guaranteed by someone else, and whose gains belong to itself, will take risks that no unguaranteed institution would take. That is not a moral failing. It is the correct response to the incentives, and any competent management will eventually arrive at it. The guarantee is not the error. Deposit insurance is genuinely valuable. It stops bank runs, and bank runs destroyed the American banking system repeatedly before it existed. The error is a guarantee without a corresponding constraint. Insurance normally comes with underwriting. The insurer inspects, prices the risk, and restricts behavior that would increase it. Federal deposit insurance in the 1980s did none of those things. It charged a flat premium regardless of risk, so a conservative thrift and a casino-owning one paid the same rate, which means the conservative institution was subsidizing the reckless one. Then deregulation removed the behavioral restrictions that had been standing in for underwriting. The guarantee stayed. Everything that made it safe was withdrawn. Which is why 2008 rhymes rather than repeats. The mechanism reappeared in a different form. Institutions that believed they were too large to be allowed to fail carried an implicit guarantee rather than an explicit one, and that implicit guarantee lowered their funding costs and encouraged exactly the leverage you would expect. Nobody had legislated it. It did not need legislating. A widely shared belief that the state will not permit a failure produces the same incentive as a written promise. The 2008 response also repeated the forbearance instinct, though for a shorter period, and the lesson from the 1980s that delay multiplies the bill was at least partly applied. There is a comparison worth making because it shows the counterfactual is real. The commercial banking system had serious problems in the same period, including a wave of failures and the near collapse of several large institutions. It did not produce anything on the scale of the thrift crisis. The differences were that banks had more diversified assets, faced tougher capital rules, and, critically, were not permitted the same accounting conventions. The thrift disaster was not an inevitable consequence of a hard decade. It was the consequence of a specific set of choices about accounting, capital, insurance, and supervision, made in response to that decade. It is also worth saying what actually worked, since the story is usually told entirely as failure. Closing insolvent institutions promptly works. Every year of delay increased the cost, and the cost stopped increasing when closures began in earnest. Risk-based insurance premiums work and were introduced afterwards. Charging an institution for the risk it actually presents restores some of the discipline that a flat premium destroys. Prompt corrective action, a legal requirement that regulators intervene at defined capital thresholds, rather than exercising discretion about when to act, was legislated in 1991 precisely because discretion had been used to postpone every difficult decision. Those reforms came out of this crisis, and they are the reason the banking system handled the early 1990s better than it handled the 1980s. It is worth walking through a single institution in detail, because the aggregate numbers hide how the machine actually ran. Empire Savings and Loan of Mesquite, Texas is the cleanest example, partly because it failed early enough to be studied thoroughly. In 1982, it was a small, ordinary thrift with assets of around $17 million. 2 years later, it had assets of over $300 million. That is roughly a 20-fold increase in 24 months, achieved almost entirely through brokered deposits, money gathered nationally by brokers and placed in $100,000 blocks because Empire was paying the best advertised rate in the country. What did it do with the money? It financed condominium developments along Interstate 30 east of Dallas. The transactions involved land being sold repeatedly between related parties, each sale at a higher price than the last, with Empire lending against the newest and highest valuation. Nothing about that requires a buyer for a condominium. The profits were generated by the transactions themselves. Appraisals supported the prices because the appraisers were being paid by the people setting them, and each recorded sale became the comparable evidence justifying the next. When it was seized in 1984, examiners found thousands of condominium units, many unfinished, several never occupied at all. The eventual cost was around $300 million against an institution that 2 years earlier had been worth a rounding error. The thing to notice is that Empire did not need to break any law to grow 20-fold. Brokered deposits were legal. The new lending powers were legal. The appraisals were, in a narrow sense, defensible. Fraud charges followed, and convictions with them, but the growth itself was permitted. The structure allowed a small thrift in a Dallas suburb to raise $250 million from strangers who had no reason to ask a single question, because the government had answered the only question that mattered. Now consider the depositor's position, because it is worth understanding how rational the behavior was on every side. You have $100,000. A thrift in a state you have never visited offers a rate 2 points above anything local. Your deposit is insured by the United States government to exactly that amount. There is no version of that decision in which you should investigate the institution. Investigating costs time and money and can produce no benefit because your outcome is identical whether the thrift is prudent or reckless. If it survives, you are paid your interest. If it collapses, you are paid by the insurance fund. Depositors are, in the ordinary course, the most effective monitors a bank has. They are numerous, they are motivated, and they can withdraw instantly. Deposit insurance switched all of that off correctly, because the alternative is a bank run but completely. And once you have removed the monitors, the only thing standing between an institution and catastrophe is the regulator. Which is why the supervisory failures matter so much more than they otherwise would. Supervision was not one layer of defense among several. After 1980, it was the only one. There were people who saw it coming, and their treatment is instructive. Edwin Gray, appointed to chair the Federal Home Loan Bank Board in 1983, concluded within about a year that the deregulation was producing disaster and began trying to reverse parts of it, restricting direct investment, limiting brokered deposits, and asking for more examiners. He was opposed at nearly every turn. The industry lobbied against him with considerable success. His attempt to limit brokered deposits was struck down in court. His requests for examination staff ran into a federal hiring freeze and an administration committed to deregulation as a matter of principle. He was, by several accounts, regarded within his own government as an obstacle. By the time he left in 1987, the crisis was substantially beyond containment, and the recapitalization bill passed that year provided a fraction of what the insurance fund actually needed. The lesson there is not that someone should have listened to one man. It is that the political economy of this kind of failure is asymmetric. The costs of forbearance are diffuse, deferred and borne by taxpayers who are not yet aware they are involved. The costs of intervention are immediate, concentrated, and fall on an organized industry with representation in Congress. An official proposing to close hundreds of institutions in 1984 would have faced enormous, well-funded, immediate opposition in exchange for preventing a cost that had not yet materialized and therefore could not be proven. That asymmetry does not go away with better people. It is structural, and it is why rules that remove discretion, like the prompt corrective action requirements legislated afterwards, do more good than exhortations to be vigilant. There is also the question of what happened to the assets afterwards, which is less discussed and quite revealing. The Resolution Trust Corporation inherited a genuinely strange problem. It held enormous quantities of real estate in markets that its own sales were depressing. Selling quickly meant accepting very low prices and pushing prices lower still. Selling slowly meant carrying costs, deterioration, and the risk of political interference over years. It chose, broadly, to sell quickly, including through bulk sales and securitization of loan portfolios, packaging illiquid assets into tradable securities to attract buyers who would never have bought individual properties in Texas. That technique worked. It also seeded an industry. A number of the fortunes made in American real estate and distressed debt over the following 2 decades began with buyers acquiring RTC portfolios at deep discounts, and several of the structures developed to move those assets became standard practice in securitization. There is an uncomfortable symmetry in that. The tools built to clean up one crisis of mispriced risk went on to become instruments in the next one. It is also worth being clear about who ultimately paid, because the phrase "cost to the taxpayer" is doing a lot of work. The $124 billion was not a single appropriation. It was financed by borrowing through a purpose-built entity, with the interest payable over decades. The bonds issued to fund the cleanup were still being serviced into the 2020s. So the cost was not paid by the taxpayers of 1989 who might, at a stretch, be said to have elected the governments responsible. It was spread across taxpayers who were children at the time, or not born. Deferral was applied not only to recognizing the problem, but to paying for it. That is worth sitting with, because deferral is the thread running through every stage of this story. Deferring recognition of insolvency in 1982, deferring closure through forbearance, deferring losses through regulatory accounting, deferring the bill itself through 30-year bonds. At every point the choice was between a cost now and a larger cost later, and at every point the later cost was chosen. There is one more comparison that makes the mechanism unmistakable. Not every country with deposit insurance had a savings and loan crisis. Insurance alone does not produce this outcome. What produced it was the specific combination: insurance that priced risk at zero, capital requirements that were lowered rather than raised as risk increased, accounting that permitted a whole to be recorded as an asset, supervision that was not resourced to match the powers being granted, and a political preference for delay. Remove any one of those and the crisis is smaller. Remove 2 or 3 and it is probably manageable. Which is the same shape as almost every institutional failure worth studying. It is rarely one decision. It is a set of individually defensible choices, each removing a safeguard that seemed redundant at the time, until there is nothing left between the institution and the outcome. There is one last detail that captures the whole thing. Deposit insurance was raised to $100,000 in 1980, and the industry that lobbied for it did so believing it would help them retain deposits in a period when they were losing them to money market funds. It was a defensive measure by institutions in trouble. It worked, deposits came back. And the mechanism by which they came back, depositors no longer needing to care whether the institution was sound, is precisely what allowed the worst institutions to grow the fastest and fail the largest. The rescue was the accelerant. Not through incompetence and not through malice, but because a guarantee that removes the need for scrutiny will always, eventually, be used by someone who does not want to be scrutinized. So the question worth asking of any financial institution is not how well it is run, or how sophisticated its risk management is. It is simpler, who bears the loss if this goes wrong, and does that same party have any power to stop it going wrong? When the answer to the first is the public and the answer to the second is no, everything else is detail, and the bill, whenever it arrives, will be larger than anybody's current estimate. There is a final thing worth saying about why this story stays obscure, because its obscurity is itself part of the pattern. It has no single day. The 1929 crash has a date, Black Monday has a date, Lehman has a weekend. The savings and loan crisis has a decade, which means there is no photograph, no moment, no footage of anyone shouting on a trading floor. It happened as a slow accumulation across thousands of small institutions, in places that television does not visit. It also has no single villain, despite Keating. The convictions ran into 4 figures precisely because the wrongdoing was distributed, and distributed wrongdoing does not produce a story anyone can tell in a headline. And the losses were socialized so smoothly that most of the people who paid them never knew. There was no moment at which a bill arrived. There was a bond issue, and 30 years of interest payments folded invisibly into the federal budget. A crisis with no date, no villain and no visible bill is a crisis that produces no folk memory. Which is exactly why the same mechanism was available to be rebuilt, in a different form, within 20 years. The 1980s did not teach the lesson people assume it taught. It is generally remembered, when remembered at all, as a story about greed and crooked developers in Texas. That framing is comfortable because it locates the failure in individual character, which implies the fix is better people. The actual lesson is structural and much less comfortable. A guarantee with no underwriting attached will be exploited by whoever holds it, and the more precarious their position, the faster they will exploit it. That is a statement about incentives, not about morality, and it holds regardless of who is running the institution. Which means the defense has to be structural too. Price the guarantee, restrict the behavior of anyone holding it, resource the supervision to match the powers granted, and remove the discretion to postpone, because discretion under political pressure will always be used to postpone. None of that is difficult to state. All of it is expensive and unpopular at exactly the moment it needs doing, which is when nothing appears to be wrong. One more thing about the people who were not institutions. The depositors were made whole. That was the entire point of the insurance, and it worked. No insured depositor lost a cent, which is a genuine success, and the reason the crisis produced no bank runs despite 1,000 failures. But there were three groups outside that protection, and they are largely absent from the accounts. The first are the uninsured. Deposits above $100,000 and money placed with affiliates rather than the insured entity were not covered. Lincoln's bondholders are the well-known case, but they were not alone. The second are the borrowers. When a thrift failed, its performing loans were sold on, and the new holder had no relationship with the borrower and no interest in flexibility. Small businesses that had been dealing with the same local institution for 20 years found their credit lines called by an entity in another state that regarded them as a line in a portfolio. The third are the towns. A great many of these institutions were the only meaningful lender in their area. Their disappearance removed local credit at the same moment. The regional economy was contracting, which is precisely when it was most needed. None of that appears in the $124 billion. That figure measures the cost of making depositors whole. It does not measure the cost of removing 1,000 lenders from communities that had no substitute for them. And that cost was real even though nobody ever wrote it down. Which is a small illustration of the larger habit running through all of this. What gets measured is what has to be paid in cash, and everything else is treated as though it did not happen. And there is a reason that habit is so durable, which is worth naming before we finish. A cost you have to pay in cash this year has a name, a line in a budget, and somebody whose job depends on defending it. A cost that lands on a town, or on a borrower, or on a taxpayer 30 years from now has none of those things. It has no advocate in the room at the moment the decision is taken. So the decision is made by the people in the room, using the numbers in front of them, and the numbers in front of them are the ones somebody was required to produce. That is not corruption, and it is not incompetence. It is what happens when a system measures some consequences and not others, and then asks people to weigh them against each other. The thrift crisis is usually filed as a story about deregulation. It is more accurate to file it as a story about measurement, about a decade in which the true cost of a decision was knowable, was not required to be stated, and therefore was not stated until it arrived as a bill that nobody in the original room ever had to sign.